Guten Morgen. Welcome to Forex.Today. Oh, you know what? I forgot my coffee. My door is wide open. Hang on. All right, there we go. And away we go. So we got sound. That's good, right? Good morning. My name is Wayne. Comment allez-vous? How are you? Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hey, can we get some confetti? Let's see some confetti, y'all. Pachow! All right, so we got another trading week in front of us. Hope you had a good weekend. Pachow, pachow, pachow! If you missed the war, well, we got our war back. We'll see how the market is going to freak out or not freak out. As you can imagine, oil would be up, and that has happened. But let's get our sit rep. G'day, Vincent. How are ya?
Good morning. Let us get you up to speed. While the broader monthly trend reflects a robust risk-on environment, today's session is characterized by flat and neutral sentiment as the market digests geopolitical headlines. The U.S. 10-year yield has edged up to 4.569%, an increase of 3.0 basis points that is currently providing a floor for the U.S. dollar index. This yield movement, coupled with a slight decline in GBP USD toward 1.3395, suggests a cautious Europe.
All right, I kind of was worried about that. Hang on. It should be. Okay. Oh, you didn't hear the music either. No kidding. All right, let's try it again.
European Open as traders pivot toward defensive positioning. 1. Middle East tensions are driving oil prices higher, with WTI crude jumping more than 3% this morning. Investors are also bracing for tomorrow's U.S. inflation data, which is expected to show core prices rising by 0.3%. Gold is currently losing ground, trading below $4,100 as U.S. Treasury yields move higher. Lastly, the British pound is seeing a minor pullback but remains resilient near the 1.34 level against the dollar. Biggest movers right now, Nikkei 225 is down. VIX, corn, WTI crude oil, and Brent crude oil are up.
Yep. Hang on. Just trying to get this laid out a little better. All right, cool. Yeah, so look at that. Well above 7,500 again on Dixie. That's cool. Happy with that. VIX is way up, though. Whoa! Well, that's obviously related to geopolitics. Oh, for sure. What else? Bitcoin, Bitcoin was above 63. Now it's just dipped a little bit below that. So that's usually indicative of a little risk off. Gold back down to 4K. That's also risk off. Oil way up. That's risk off. Dollar up. Now it says down, but still anything above 101. Anything above 100 is up. I mean, I'd like to see dollar at 97, 96, 95. Like, and we got to get the 10-year below 4.5. So, it's not a risk on scenario. No. But considering having 1,000 bombs lined up, not that big of a freak out, really. I mean, look, 73 is pretty high for sure for WTI, but why not 83? Right? Brian's saying why not 110? And so since the Asia Open, it could have been dramatically different, right? But look at VIX. 16 is bad, and a 9% jump in VIX is bad. There's no doubt about it. But we were at 21, so a huge spike to 16 is relatively terrible, but absolutely not that bad. Could be a heck of a lot worse.
Japanese yen. Consolidation near resistance band against US dollar. Societe Generale.
European gas prices surged to over 1-month high on Hormuz closure. XRP extends slide as weak demand. Bearish structure threatened key support.
New Zealand dollar. RBNZ tightening risks watched. UOB.
Global yield steady as markets weigh. Hormuz closure and inflationary pressures.
Gold price forecast. Gold US dollar drifts below $4,100, but bears start to look exhausted. Middle East tensions roil market sentiment. Canadian dollar. Supported against US dollar by steady Bank of Canada outlook. BNY.
Pound to US dollar price. Forecast bounces back to near 1.3400 as US dollar turns upside down. US natural gas power costs reach 17-year high on data center demand, Lazard says.
Yep. Would my strategy change? No. Brian, what do you think? I'm counting the dot plots, trying to make decisions on dot plotting? No. We use the yield curve for that type of analysis. Yeah. So I agree with Warsh on this subject of forward guidance and getting rid of it, because over the last, 10 years, the trade hasn't been based on macroeconomics as much as it used to be. And it was more like you were front running the Fed. You're like, who cares about economics? Let's just front run the Fed. And that's not a healthy decision-making process, because then the Fed is the market versus you trading market conditions, right? So, so anyway, so I'm happy to go. I like, for sure, kill the dot plot, whatever, get rid of it. Anywho, taking a look at risk, could be a heck of a lot worse, I keep thinking. I keep saying to myself, could be a lot worse than that. Hang on, I got to check something out. Anyways, Just checking out our week here. Hey, next week I'm going to be in Vegas. If you guys want to meet up for a cocktail and cigar, let me know. But anyways, this Monday, what do we got? Lots of speeches. Tuesday, CPI. That's good. Tomorrow's going to be a big day. Then we start the semi-annual testimonies. So Warsh will speak on Tuesday, and then he'll speak again on Wednesday. Oddly enough, the how do you say, speech, I guess you would call it, the speech has already been released. So it's really just a Q&A. And if you've ever watched these things, they're 5% useful, 95% BS politics, where Democrats are going to come out and say, you're a sock puppet for Donald Trump. And the Republicans will come out and say, oh, we commend you, sir. You're going to be the world's greatest, and blah, blah, blah. And it's all BS. Unfortunately. But they might actually get some half-decent questions in there. But, they should be asking questions about, hey, what changes are you going to make at the Fed? And why do you think they're going to help? But they're not going to. Not likely going to ask smart questions, unfortunately. It's politics. But you should watch them. Bank of Canada. Monetary policy report and interest rate decision on Wednesday. So you could check out the yield curve on Canadian treasuries and analyze the likelihood or probability of a monetary policy change having been priced in. You have that type of data at your fingertips. UK GDP on Thursday, that's a biggie. CPI out of Europe, that's a doozy. Retail sales out of the United States, that's also very important. Friday, a lot of real estate. Yep, a lot of real estate. That's really good because that is part of I in GDP. How do you spell GDP? C plus I plus G. So that's part of the I. And of course, if interest rates are high or expected to go higher, that could be a negative impact on the housing market in general. But remember the behavioral finance. If you expected interest rates to go up soon, you should buy a house today and get a mortgage at the lower interest rate. See, if you think interest rates are going to go up, buy now. If you think interest rates are going to go down, wait and get the lower interest rate later. Some people think if the Fed is cutting, that helps the real estate market. Yeah, it's when they stop cutting. Yeah. So anyways, we got a nice week in front of us. That's nice. Okay, markets are tight. Corn is way up. But you have to realize that corn and or let's say food and energy are up, one has to do, well, I guess both are directly related to the Strait of Hormuz. So if you can't get oil out, then that's an exogenous supply shock, and right supply side dynamics would indicate the price would go up. But this also impacts things like fertilizer. And so there will be a shortage of food and prices go up. So on the one hand, let's say sorghum prices go up and our favorite sorghum producers, you know, you would think would be better off with the higher price. But then if they have a lower yield, then what? Then you're like, oh, you're, oh, can't win. So corn prices going up is a sign that food's expensive because we're going to have less food available. So you're going to have to pay more. That's just that. Just kind of looking at our stock indices. Yep, it doesn't look like terrible risk off here. Matthias, we don't have much in reserve. If you're talking about the Strategic Petroleum Reserve, if somebody attacked the United States, I think we can hold out for hours, not weeks. It's pretty bad. You're like, wait, hours? Yeah, I don't think we have enough to even go to a day. But I might be wrong. Maybe it's 2 days. And then we run out of gas and oil. But don't worry, Matthias. We can run our Humvees on cooking oil. And we have plenty of that in America. Okay, Nikkei having to pay a lot of money for oil. But you know this. We talked about it last week. You should be prepared. We've talked about it a lot. So if Japanese companies have to pay more for oil, then they're going, or let's just say energy in general, well, that eats into profits. Pretty simple. What do we see here? Swissy up, or I guess down, right? Swissy down, Swissy down, Swissy down, Swissy down, Swissy down. Hey, what do you think? Swiss franc might be weak. What do you stink? Pound and euro, pound has been strong for a while, and not today. Maybe Canada benefits from higher oil prices. CAD yen up ever so slightly, basically break even, huh? Yeah. Pound CAD down a little bit, USD CAD down a little bit, Aussie CAD down a little bit. So there is some kitty CAD strength there. Euro CAD down a little bit. Unfortunately, Canadian financials are a mess. And higher oil prices are still not likely to save Canada, unfortunately. Crypto, remember we were or are bullish on Ethereum in particular. We had a nice little dip on our trade plan. Let's see. Can you guys see that? No. Hang on. The way I'm broadcasting is a little unusual. Now you can't see anything. Hang on. Gee whiz. Okay. I'm just checking out the way that it's broadcasting, and it's still... All right. Well, what I'm trying to show is my Trader's Way platform. I guess maybe I can try it this way. Oh, is it a window? Let's see if this will work. Can you see that? Yeah, you see that? All right. So this was one of the trades that we had set up quite a while ago. And first entry was on the bottom. Second entry, this is sort of a third entry. It did make a higher high, so hopefully it makes a higher low. Ultimate target well above 2K. And my stop's at break even already. But this was from last week, right? So it's a slow grind. Hopefully we stay above this role reversal type area. Is kind of what I'm eyeballing. I can move my stop a little closer. But this setup based on macro and seasonality, actually, more than macro. So look, we were doing great, and then suddenly over the weekend, there was a collapse in our memo of understanding / peace deal. So crypto crashed. It's sensitive to such things. So of course Ethereum came down. But when you look at years and years and years and years and years and years of Ethereum price action, we're buyers of dips. But we are vulnerable to exogenous shocks. Like war. War is not usual. Okay? See what I mean? War is not usual. So maybe I get knocked out. Well, you know what? I took a shot based on logic. But if it finds support somewhere, I may add another one, because we know the history of Ethereum has produced, doesn't mean it'll produce it this year, but the history of it suggests, what was it, 22 or 26% increase in Ethereum right around now. Okay, so as long as we don't get killed by geopolitics, normally, how about that? Normally, in the past, which does not predict future results, but maybe it goes up. But it's not a dumb idea. Resets would be off the bottom or off the top of our buy zone. That green area is our buy zone for the month of July. But once again, we've covered this for days and days and days and days and days. I mean, if we're in the middle of July and you're just figuring out the monthly strategy, you're like, what have you been doing, bro? Bro! Don't call me bro. Yeah. Anyways, so we were talking about that, and anyways, it's come about, but will it survive? I don't know. Right? Yeah, anyways. All right. All right. All right. All right. Yeah. Swissy pairs on the move. Oscar Mike. See, the things in the middle here are quite neutral. Okay. But CAD Swissy up. Pound Swissy up. Aussie Swissy up. Kiwi Swissy up. Something to look at. Nikkei is very bearish with oil going up. Okay. Okay. Makes sense. Looking at some of these scores. Ooh, let's organize them by asset class. These are your best trades right here. Up, 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 down, down. Nikkei, very bearish score here if you're trading stock indices. S&P 500 slightly up. Nikkei, hard down. All right. All right. All right. Look at the NatGas. If we get rid of the asset class filter and just say, what should I be doing? Kiwi Swissy up. Like NatGas down, but I don't know if that's going to stick with the geopolitics. Nikkei down makes sense. Okay. Yeah. Remember, most of this is fundamental, not necessarily technical. So, in a macro score, you're not thinking geopolitics. That's just not what goes into that math. So nat gas usually falls this time of year. There's no doubt. And in my mind, so does oil. Let's try to find it. Crude oil, that's euro pound, right? And then here it shows slightly up. Just trying the best way to grab this. No, and there we go. Yeah, in my brain, though, it's down. But I think this might actually, because 80% of this is macro and 20% is technical, I think it's showing a little bit of bid on the analysis there that wouldn't be seasonal. But maybe I just remember it wrong, huh? All right. We'll go through it here, just eyeballing. Soybeans, wow. Heavily short Litecoin, Cardano. Yeah. Gold pretty flat this week, even though the market's heavily long. Institutional investors are not buying. And I think I told you this last week, but Aiden in the background, our AI, he's not even AI anymore. He's a neural network, and he's knee deep in machine learning, and he's making a lot of trades, combining technical and fundamental analysis. And he's actually getting pretty good. He also tested my personal strategy of swing trading, and he did extraordinarily well. Of course he did. But now we proved it quantitatively through back testing actual data, like what actually happened. All right, so he's doing good there. But one of the things he's doing in his neural network, which I didn't specifically ask him or design him to do, but that's what a neural network is. He noticed a dichotomy of institutional trading and retail trading, and he's getting it from this data, and not even and I think I need to add to this, because what he's doing is, instead of just looking at pure institutional flow, he's looking at retail flow, which we get from the data. We pull it from the CFTC. So he's looking at situations in which, like with gold, let's say he looks at the CFTC data for gold and sees retail selling of gold. Okay. Then he looks at the institutional side of it. And institutions are heavily long, and they're not selling. They're not buying, but they're not selling. And he's analyzing all of this for all assets, and he's watching the market, and he's saying, hey, does this divergence between institutional investors and retail traders, does it create an opportunity? And if so, what is the scope and magnitude of this opportunity? And and I'm not now teaching him this, although I understand it. He found all this on his own and is watching and testing and learning from it, which is far beyond what your crap GPT can do. Cool. Peso, heavily long, but no buying. So we want to look at flow that lines up. Slight buying of silver in a decently long market. I don't see much, I don't see really dramatic changes here. Dow, actually. Ooh, look at that. So is this rotation into a lower beta? Look at the change of flow into Dow. And so this would have been reported the 7th and come out on the 11th, if I remember that correctly. And that's not far from when the Council of Investment Advisors were discussing our rotation and balancing of our portfolio. And we discussed moving into a lower beta. And you can see it happening here. Where are the other S&P 500? Okay. Institutions are short, but nothing happened. And look at this, short, but some buying. So I think it's interesting. And I wouldn't have done it this way myself, but this is why we have the data. They put some money into the higher beta, but most of the money in the lower beta, and they left the S&P 500. Like, they're not trading it. Interesting. I would not have thought that. Now, actually, as a portfolio strategist, makes me wonder myself, what could I learn from this? Did they do 2/3, 1/3 to get a hybrid beta exposure? Because they're like, well, what if NASDAQ doubles and takes off and doubles? I don't want to remove all my risk to that, but I want to stay in a period of fizzle, because this time of year the market kind of fizzles out. Can you hide out in global monopolies? That should produce a lower beta. And so anyways, kind of interesting. Look at the increase in exposure to the Dow. And this shows you institutional investors are short NASDAQ. Very interesting data. Flat, 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 flat. Selling of Solana, selling of Ethereum. Excuse me. Flat, selling of Bitcoin, which is all very unseasonal, but that's why it's been very difficult to catch any fish this week. And food just going up, huh? Food. Maybe this is interesting for us. The market was doing the carry trade and have been doing at least some profit taking. That's interesting, isn't it? Cool. Do you guys like the fact that you can see the truth? This is your legal and ethical inside information to see what institutional investors are actually doing with their money. And this is what we saw. S&P 500 flat, NASDAQ up, Dow even more up. Yeah. Brian says, why would the Fed raise interest rates? And you're talking about debt. Well, irregardless of debt, but I know what you're saying, because that makes our debt service level more expensive. But also people are suggesting that the Fed's going to raise interest rates because of high inflation. But what I've pointed out many, many, many times is that the Fed handles one side of the equation, the demand side of the equation. They have no impact on the supply side. So we have a supply side shock. The Fed could jack up interest rates all it wants. It's not going to cure the problem. It's not going to open the Strait of Hormuz and return our supply of energy globally to a normal level. So in my humble opinion, if the Fed raises interest rates, the only thing it'll do is make the cost of money more expensive, while energy is more expensive. Okay, well, maybe there's a plus to that. Maybe then the dollar strengthens and brings down the price of food and energy in terms of dollars. I think that's a little bit of a stretch, because I think the other thing it's likely to do is increase the unemployment rate. and bring down the stock market, because a higher borrowing cost is going to make U.S. corporations and U.S. people less profitable. And if you raise interest rates one or two times this year, then what will happen is mortgages will go up, and that part of the economy will collapse, and new car sales will collapse, and so on and so forth. And companies will be less profitable, in particular Russell 2000 type companies. Oy vey, right? So I think the Fed might understand that monetary policy does not impact the supply side of the equation, but higher interest rates is likely to lead to higher unemployment, which they can control, and that is their dual mandate to make sure, yes, inflation is in check and the economy is healthy. But if they can't do anything about inflation, would they do something to push up the unemployment rate? I don't know. Not everybody understands this, and of course I could be wrong, but what we can do is read the tea leaves of what other people think. In particular, institutional investors. So all I can tell you is by the end of the year, there is one hike priced in. And very shortly after, not very shortly, but 6 months later, a cut. So, would the Fed raise interest rates and then cut interest rates? Or would they just hold through it? Well, Brian says neutral for now. Well, what we do see is there is a hike, one rate increase priced in. That's what the math says. So you can say there is one priced in. Yeah. That's all we know. So you can't say neutral for now. Well, that's not what this says. That might be our opinion. Okay. But I'd rather you say, well, I don't think they should, but there's a 32.1% chance that they do increase interest rates at the next meeting, according to the yield curve analysis of U.S. Treasuries. Then I'd go back to my opinion. But if I were me, I would think Warsh is more interested in changing management structure and strategy at the Fed over the next 6 months than changing monetary policy for something that he personally would believe would have no positive impact. It's not that he's a slash and burn interest rate guy for Trump. That is wildly misreported. Right? I mean, for those that believe that, in my opinion, I think you're so far off it's almost a joke. Do some research. Go back in history. Don't read your media. Read the meeting minutes. Go back to when Warsh was sat on the Board of Governors and the FOMC. Read what he was saying at the time. Do not read media. Because they call him a flip-flopper and a sock puppet for Trump and all this. That is not true. But don't take my word for it. Don't take media for it. You know, don't listen to Fox defend him. Fox News, whatever, they're also biased. You, if you actually cared, would go back and read what was said at the time, knowing what they knew at the time. He's anti debt. He thinks the debt level's terrible. He was anti-quantitative easing. But he gets called flip-flopping. He's like, no, read the minutes. He was against quantitative easing. And when the Fed, had interest rates at 0, he's like, this is stupid. He thought, right? And then when it was 10%, he's like, this is stupid. Buying debt, he said it was stupid. So anyways, if you put that into context and you don't listen to CNN and you don't listen to Fox, instead you do your research, you might get a sense of who this person is and their decision-making process. And you say, well, the market's pricing in a hike, but if I were to skew my own opinion now, because remember, this is the opinion of other people, of now smart money, but it's also on aggregate. So some people are going to be way too conservative, and some are going to be way too hawkish, and the aggregate gets pushed one way or the other based on the skew of these opinions. But you can say, okay, well, we do see one hike is in fact priced in. However, your opinion could then be skewed and say, well, I'll give you mine. I don't think Warsh wants to raise interest rates because I think he understands it won't actually help. And I think he'd rather reform the Fed right now than make monetary policy changes. And that would skew me to neutral, as Brian said, but that would be my opinion. Okay, what we see is a 32% chance of a hike on July 28th, a 51% chance hike by September 15th. Yeah, these are big numbers, right? These are big. So by the end of the year, there is one hike priced. There is. Will it change? And by the way, hike 4.0, 4.0, 4.0, 4.0, 4.0, 4.0, 4.0, 4.0. Okay, one and done. So then we will say, how will this change? Are they changing the metrics for CPI? Well, first of all, they use PCE. They don't even use CPI. But I think they should. I think CPI, PCE, non-farm payrolls, I think they're grossly outdated methodologies. And I'm very happy for somebody to come in and say, hey, if the Bureau of Labor Statistics says we expect 100,000 jobs to be reported on non-farm payrolls, and then it comes out 150,000, And then the next month it's revised down to 110,000 or down to 90,000 or down to 125,000. You're like, wait, whoa, 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 whoa. Your methodology could be off by 50% and then revised down by 35%. Then your methods suck. How are we supposed to plan if you're like so ridiculously off? The methodology itself, I'm not talking about manipulation. I'm just talking about the methodology. Wait. You call people on the telephone and survey them? Really? Maybe some AI could help. What if instead of calling 1,000 people on the phone, what if instead we analyzed millions of companies using artificial intelligence, right? You know? So if someone wants to come in and modernize the Fed, you know what? Why not? Let's do it. And now to modernize the Fed, then you'd need to modernize the stats that go into the Fed. So that would require things like Bureau of Labor Statistics, Bureau of Economic Analysis type agencies to also update their methodologies. Right? And, the basket and CPI and PCE, how sensitive are they to changes and how good are they at updating with substitutions, that kind of stuff. Is PCE and CPI good at capturing the changes in pricing in GPUs? Yeah, my son just bought a 5070 for like $600. A 5070. Cheap. So that kind of processing power, I wouldn't be surprised if it's dropped 80% in the last 3 years. 3 years, 80% cheaper. Does the government capture that level of productivity well? You're like, well, Wayne, nobody buys graphic cards for gaming. Whoa. Well, some people use it for gaming. Some people now use it for AI processing. Somebody might use it for Bitcoin mining. The thing is, it's compute. And 5 years ago, you never heard anyone talk about the price of compute and the price of tokens. And now you're standing on the side of the freeway holding, a sign that says no more data centers. No, Brian, no, it is not. I'm not against it, but I own gold. But anyway, so we have all the data, which is totally fantastic. And because the secret sauce here is lining your trades up with institutional investors. You don't want to spend your hard-earned money fighting institutional investors. So, what's your opinion on Canada this week? Are they going to cut interest rates? If you analyze the Canadian Treasury market, the answer is they are paused at this meeting. I think I'd like to audit this though. So just in sort of process, just so we understand each other, I always challenge the data. So I'm like, okay, I'd like to challenge this data a little bit. Okay. And so I will. I'll go think about it. I'll go think about it. Oh, faux show. So as you already know, Swiss franc is weak. We already identified that here on the contrarian radar. Swissy weak, Swissy weak, Swissy weak, Swissy weak, Swissy weak, Swissy weak, Swissy weak. Best thing you could be trading right now, Kiwi Swissy. We've been bullish on Kiwi for 10 days. Does that sound about right? So then we go here and you're like, wait, Kiwi Swissy is a great trade. Yeah, for sure. Okay. Up half, down half. That's a nice little trade. The other way to look at it, like, hey, if you're buying Swissy, or sorry, selling Swissy, okay, boom, 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 okay, puts it in order. Yeah, Kiwi Swissy. Swissy is weak. Okay. Quote is strong. Quote is strong. Swissy is weak. So anyways, yeah, there you go, bro. Energy is up, as you can see. And crypto is down, but I'm waiting to buy. And like I said, we analyze seasonality on these suckers. And it was a good opportunity to look for opportunities to buy dips. We don't know if there'll be follow through. In particular, this is negatively impacted by our current negative geopolitics. But if that changes, bada bing, bada boom, this could go risk on again, and that would be normal. And we also know Ethereum is the best opportunity based on seasonal analysis. And that's the one trade I'm in. I'm long, I'm profitable, my stop's at break even. So now I just need peace in the Middle East. I just kind of want to eyeball where we are. Swissy pairs in general. Pound Swissy, dollar Swissy, Kiwi Swissy. They're all looking good on the daily, huh? Look at Aussie Swissy, beautiful. Euro Swissy, look how beautiful these day charts. CAD is just rolling over, but CAD's been a dog with fleas. Yen is strong right now, but it already organizes it in order. So start with that, right? Buy dips. Start then this, buy dips. Then this, buy dips. Then this, buy dips. Then this, buy dips. And then meh. Isn't that nice? Gorgeous. Okay, and then here's our Kiwi pairs. And we've been bullish all month on the Kiwi. And they're definitely waking up. Kiwi CAD is the best. Kiwi Swissy is good. Kiwi Yen is good. Pound Kiwi, I would look to sell rallies, but not just having the price being lower than the moving average isn't enough. I would look for a pullback and then drop it like it's hot. Kiwi dollar, no. Pass. Neutral, see? Neutral. And then I look at the chart and I agree with that. And oops. And then I look at this chart and it says neutral, and that's basically what I said. Lower low is not enough. I need a lower high and then drop it like it's hot. Aussie Kiwi, maybe on a pullback. Euro Kiwi, yep. Right? Again, sell a rally off the moving average. Big fat maybe. Yeah, there's some opportunities out there. I was thinking about adding stocks. Would you guys be interested if I brought in, let's say, the top 20, top 10? Top 10 most traded U.S. stocks? Not just indices, but individual stocks. I mean, you're the boss. What would they be? Apple, Nvidia, that type of stuff? What do you think? I was also thinking of teaching Aiden how to do options trading strategies. Anybody interested in options on stock? Okay, positive response. I was also thinking teaching Aiden how to trade under prop trading rules because he's learning how to trade, well, like you're supposed to, right? Well, what about prop trading firms? They have different rules. I don't know. I don't use prop trading. But I wonder if he could succeed under, let's say, standard prop trading rules, and if I can teach him how to adjust to incorporate those new rules of engagement, and then maybe be able to share them with you if you do use prop trading. Now, I think your trading style or strategy will change because the rules of engagement have changed. Like you still might be a swing trader or a day trader, but we might have to make some adjustments. I don't know, but wouldn't it be cool if you can adjust the way that Aiden displays data to you because you specifically are a prop trader and you're like, hey, give me analytics based on these unique sets of, rules. Do you think that would be helpful, or is that a big waste of time? Yeah, but I can tell you he's learning extraordinarily quickly on how to trade. I'm very, very happy with his progress. I mean, almost shocked, actually, how good machine learning is if you give it good data. Do not use, and I say it, let me say it again clearly, do not use publicly available large language models to try to create trading strategies or trading bots. They're trained on the internet, which is crap. So it's garbage in, garbage out. You do not try to invent the holy grail using ChatGPT or some other Claude. Claude doesn't know how to trade. Claude knows the internet. And because of that, you're going to fail. So learn how to trade. Claude 100% knows how to not trade because he's filled up with internet garbage. It's a fool's errand. Aiden, however, is amazing because he only knows what I taught him, and now he's testing it with real data and back testing it with real data. We have all the data, technically and fundamentally, in price, and he's learning extraordinarily fast because all he has is pure trading knowledge and has no internet crap. None. Super cool, man. I'm telling you, it's super cool. Denny says prop firms can be a waste. Well, I imagine it depends on the prop firm. And the rules. I'd be concerned that you want to be a Forex trader, but you don't have any money, so you're going to use a prop fund. I would say get a job and practice for 5 years. Bankroll yourself. And when your skills are unbelievably high and you've saved a ton of money, trade, because by then you'd be professional. You'd be very good. That kind of stuff. But whatever. Maybe I'm just old school. That's how it was back in my day. Forex was for kings and queens. Right? Forex was for rich people. Right? You can bet on the horses or you can own the horses. But whatever. So so it's just a different model. And if you start there, I guess, and if you're a decent trader and you have a bunch of these accounts, does it add up? I guess. I don't know, but I guess. But it'd be interesting if we could quantitatively analyze the rules. That's different, right, Denise? Analyze the rules and see how it may impact like our day trading, our swing trading, and our position trading radars, where maybe there's a tab or a toggle or a setting that you can click on to say, change the view according to generally accepted prop rules. So maybe it makes more sense for me to discuss like the near future for these radars, these technical radars. They're going to go through a next version where Aiden can provide to you significantly improved technical analysis, right? Like this is good and it's very simple, but it's not dumb. It's just providing very clear, analysis. Even most of what it does isn't even shown, like multiple sets of pivot points. Like on this, we're looking at monthly and annual pivot points. It's tough to display well, but it's in Aiden's mind, right? And we're looking for overlaps, and we're looking for linear projections, and we're doing standard deviation calculations. We're calculating MACD and stochastics and all the moving averages that we like to use. Like there's a lot going into this, right? There's a lot. So one of the thoughts is, well, then give it prop trading rules. How would he respond? And maybe there's a situation where this is a good swing trade, but if you're under prop fund rules, maybe it's not. Maybe you revert down to 2 day trades or 3 day trades instead of 1 swing trade. And maybe, or it allows for a better opportunity to compound. I don't know. If I can teach him how to trade, I can teach him how to trade under those rules too. He trades well under my rules. But if you guys are like, you're not interested in what you're like, if sort of having Aiden help you with prop trading is a distraction, let me know. If you're like, dude, that sounds epically cool, well, then let me know. All right? It would be for you. I don't trade prop funds. But if you join our rewards program, if you join our rewards program, when you link your account, right? When you link your account, it's going to give you a spread rebate. So your spread lowers and you get an equity boost, which lowers your cost of leverage. It's almost becomes a prop-like situation in which you have more equity to trade, but you can trade in any style you want. You can scalp, you can spot, you can swing, you can hold over weekends, you can carry trade and collect the yield and the swap, and you keep 100% of the profits. And it pays for trade hours. And did I mention you get a cash rebate on your trading? So a lot of people like those cash rebate type programs. Cash gets put into your account every day based on your trading. All of this is part of TradeRs right now. It's already built in. But if you needed a prop account, well, fine, whatever. But we already have all of this built in. Yeah. Ooh, a long day, man. I've been up for hours and hours. It's 9:30 and I'm ready for a second lunch. Yeah. So anyways, everyone here should be part of the rewards program. Right? Like, for example, I make 3 trades a day. I do mini lots. I do 2 mini lots. Oh, your Pro Max subscription's going to drop to $29 a month. It's an 85% discount. Dude. 85% discount, cash rebate on your trading spreads, an equity boost to your account to lower your cost of leverage. Like, dude, WTF? Dude, WTF? What the fudge? Right? You kind of need to be in the rewards program. But anywho, what more can I do, huh? So I will see you later. Peace on earth. May the pips be with you. May your profits be above average. Stock market's opening. Ding, ding.